Aaron reconciles vendor payments on outdated software that freezes every 20 minutes. The office has no windows, and the air carries a faint mix of dust and overheated wiring. It is late evening, and most people have already left. His screen is still open, filled with rows of numbers and small discrepancies that seem too minor to matter. This is his job. It pays enough to continue, but not enough to change anything. Aaron's paycheck arrives at the same time every month, and the amount never varies. His expenses follow the same pattern. Rent, utilities, groceries, transport, and his father's medication. The margin between what comes in and what goes out is narrow and consistent. He tracks it carefully, and it always balances. That is the problem. An email arrives from the hospital billing department. Aaron opens it immediately. The number has increased again. It has been rising slowly for months, and there is no error this time either. The system is working exactly as designed. He closes the email and returns to his screen, but the numbers in front of him feel smaller now. That night, Aaron does not panic. Panic requires energy, and he has already learned to conserve it. He looks at his bank balance and recognizes that nothing has changed in years. The realization is simple. Nothing changes unless the structure changes. The next morning, before work, Aaron opens a brokerage account. The amount he deposits feels insignificant, almost unnecessary, but he does it anyway. He chooses a broad index fund and sets a recurring contribution. It is not impressive, but it is consistent. He automates it so he does not have to think about it again. Aaron is not trying to get rich. He is building a system. Weeks pass, and externally nothing changes. The same office, the same work, the same conversations. But internally, something shifts. Aaron begins noticing patterns he had ignored before. A vendor consistently overbills by small percentages across multiple invoices. Individually, the amounts are minor, but together they are not. He documents everything, verifies it carefully, and sends a concise report to his supervisor. The supervisor calls him in a few days later and asks how he found it. Aaron explains his process without assumptions. The company recovers the overpayments, and Aaron receives a small bonus. The amount is not important. The sequence is. Aaron repeats it. Another discrepancy. Then another. Each one slightly more complex, each one resolved quietly. His name begins to circulate within the company. Not widely, but enough. A few months later, someone from another department asks for Aaron's help reviewing their process. He agrees. It is disorganized, so he standardizes it over a weekend. They pay him for his time. This is new. Aaron is still employed, but money has started moving toward him from a second direction. He increases his automated investment slightly. Time begins to compress. Months pass. His father's medical balance stops growing and starts decreasing. Aaron takes on a second client, a small logistics firm with even Messier records. He rebuilds their system and charges a modest monthly retainer. It is small, but it repeats. After a year, the medical debt is gone. Aaron does not celebrate. He simply redirects the same payment into his investment account. The structure remains, only the destination changes. At 28, Aaron has a pattern. At 29, he has options. He begins studying real estate during his lunch breaks. Not trends or speculation, just the mechanics. Financing, rental yields, vacancy risk, maintenance. He keeps it to himself. A client mentions a property they cannot sell. Aaron asks for the details and visits it himself. He walks through every room with a contractor, focusing only on structure and cost. The estimate is manageable. He runs the numbers that night. The margin exists. Aaron approaches a bank. They decline. He tries another lender. Same result. He does not argue or adjust his approach emotionally. He continues. A smaller credit union reviews his application differently. They focus on his consistency and documentation. Aaron has records for everything. They approve the loan. The payment is fixed, and his projected rent exceeds it slightly. That is enough. He closes. The first months are inefficient. Repairs take longer than expected, and costs rise slightly. Aaron absorbs it. A tenant signs, then another. Cash flow begins. It is not passive. Aaron handles everything himself. When a tenant misses a payment, he follows the process. Notice, filing, replacement. No emotion, only execution. The system stabilizes. At 31, Aaron acquires a second property. At 32, a third. His investment account continues growing quietly in the background. He does not interfere with it. Contributions remain automatic, and market fluctuations are ignored. Aaron's income now comes from multiple sources. He reduces dependence on his job gradually. A former client introduces Aaron to a property developer. Their projects are larger, and their systems are weaker. Aaron identifies inefficiencies and presents them clearly. They listen. He is retained. His work begins affecting larger amounts of money, and his compensation adjusts. Aaron is no longer solving small problems. At 34, Aaron is involved in evaluating a distressed commercial property. He builds a model with conservative assumptions and multiple scenarios. The downside is survivable. The upside is measurable. The project moves forward. Aaron is offered a small equity position. He accepts. The process takes time. Leasing is slow. Market conditions shift. Financing tightens. Aaron adjusts and waits where necessary. Eventually, the asset stabilizes and is sold. His share is larger than anything he has earned before. Aaron does not celebrate. He allocates it carefully across investments, reserves, and future opportunities. At 36, Aaron leaves his job. Not suddenly, but gradually. His other income streams have already replaced it. He formalizes his operations into a company. The structure matters more than the effort. His portfolio grows steadily. Each acquisition follows the same disciplined process. Aaron begins working with external capital. At first small, then larger. By 38, he is sourcing deals for investors and earning through equity and performance. He spends more time analyzing risk than chasing returns. When the market declines, his asset values drop on paper, but his cash flow remains stable. Aaron does not react emotionally. The system was designed for this. At 40, Aaron's net worth crosses a level that once felt distant. He checks it once and moves on. His family's needs are fully covered. Aaron restructures his holdings into clear, protected entities. He consults professionals where needed, not for direction, but for precision. At 42, Aaron participates in larger deals alongside institutional partners. His role is clear. He identifies value, structures entry, and monitors performance. He is no longer building from nothing. Aaron is managing something that continues to move. At 45, Aaron reviews everything. Assets diversified. Income stable. Risk measured. Nothing feels finished. A credit contraction begins in a foreign market, and lending tightens quickly. 2 of his tenants are affected. Aaron returns to his models, adjusts assumptions, and maps scenarios. He does not rush. He does not hesitate. The system remains intact, for now. Aaron closes his laptop in a quiet room. The work is not over. It never is. The market will open again tomorrow, and it will not consider what he has already built. It will only respond to what Aaron decides to do next.